So how do people use the cash value in their whole life insurance policy as a personal line of credit? This hits on the second core benefit of the cash value with whole life insurance policies, which has to do with the liquidity. So this specifically addresses policy loans and how they work. So we're going to look at an example of a policy loan, and we're going to go through it line by line. What we will look at is the same policy we had ended our last video with, which was the individual in his mid-50s. He funded a policy with $250,000 per year for 4 years. What we will look at first is that policy and what does it look like if I just let it sit and grow, and then directly compare it with the same policy, but where I borrow or take a loan and then repay that loan. So let's take a look here. So to begin, what we have on the left is the illustration that we looked at in our last video. So what we have here, $250,000 per year for 4 years. There's his total funding, $1 million in. Cash value, just about made whole. Year 4, we get all of your money back. Year 5, you're positive. So this is the growth illustration. And again, what we want to look at with this policy when we look at the loans is the impact that loans have on your money. But one thing I want to hit on here, because this question does come up, is look at your death benefit. Year 7 to 8, it drops there. That's optional. And it's a lever we pulled in this policy. So what we did here was reduce the death benefit in order to minimize expenses as early as we could in order to maximize the cash value growth. If we were to look at the growth illustration only, and we can go back to that here, here's what you'll see. Look at year 6 to 7 with the growth. Grows 43,000 year 6, 45,000 year 7, then all of a sudden takes a nice little jump to $52,000. Why we see that boost in cash value growth is again because we minimize the death benefit here in order to maximize the cash value performance. So on to the loans. Let's look at the same policy, but with a loan. We're going to take one and then we will repay it. So what we'll look at here is one $500,000 loan in policy year 8. Here's our loan balance along with the loan interest rate. The loan interest rate in October of 2023, when we are shooting this video, is 5.29%. Generally, you'll see loan rates range between 5 and 6%. Sometimes they'll be fixed, sometimes they will be variable. It depends on the company and product that you select. But this is what we're looking at for this specific illustration. Then we've got the loan interest that's accruing. And then we have our loan payments. So we have loan principal payment here. This is actually a loan payment that is being applied toward the principal and interest. And then we've got our cash value and death benefit. Okay, so here's what I want to focus on here. Let's look at year 7, which is the last year before we take a policy loan. And when we look to the left, specifically at our cash value and death benefit, what do we see? 1.12 million in cash value and just over $3 million in death benefit. When we look at the example to the right, everything is identical. Okay. Next year, we take that $500,000 loan. What happens? To the left, you see your cash value and death benefit and what it would be if you don't touch it. To the right, what do you notice? Your cash value and death benefit are lower. How much lower? Let's begin with the death benefit because that's simple. The death benefit will be exactly $500,000 less than the example you have on the left. So if you have a calculator, you can punch in that 1.745907, subtract $500,000, and you'll come up with a death benefit in the far right. And you'll see that on the actual illustration from the insurance carrier as well. The cash value drops by almost $500,000. It's a little bit more actually. The reason why it's a little bit more is because when we take that cash value, what we do is subtract the $500,000, and then the illustration will also subtract that loan interest. So if you subtract $526,000 and change, that's the number you'll come up with for the cash value. Now the cash value is your available equity, meaning you can still borrow another $640,000 in this particular case. In this example, what we're doing is repaying it at $100,000 per year. And that's our net payment in this particular case. So what's going on is $26,000 in change comes due in interest. In this example, what this is assuming is that we apply $100,000 per year net toward our loan, which will first be applied toward the interest, then toward the loan principal. What a lot of people do is first pay the loan interest and then apply money toward the principal over the course of the year. This assumes we're not paying the loan interest on the anniversary date. We're just applying $100K per year toward the loan, and we are chipping away at the loan interest as a result. But our $100K payment first satisfies interest and then is applied toward the principal when we look at it. So in this example, what is going on here? Well, as we continue to chip away at it, we see our loan balance shrinking, and we pay less in loan interest every year. The last year, we make a loan payment of about $96,000 in change. Where that comes from is the loan principal of $91,000 in change, plus the loan interest of $48.26. Okay, so that demonstrates our payments, but what is the impact of your policy? And this will answer the question how people use these policies as a personal line of credit. So let's pretend you took that $500,000 and went out and bought a piece of property that yielded you a high return. You invested it in your business, whatever your trade is, whatever your specialty is. When you took that $500,000 out, you continued to earn dividends and interest on it. And how you can see that here, like a line of credit, when the loan is repaid, your cash value and death benefit for that matter is 100% restored to what it would have been as if you never touched it in the first place. So how people use this as a line of credit is like this. They know they can put money here. It'll continue to compound for them forever because it is a safe area to position money. I know I can access it like a personal line of credit. I can borrow against whatever my total, my available cash value is. And when I repay it, when I pay it back, I see my cash value restored plus time. When I pulled $500,000 out, I didn't stop earning interest on it. It keeps on compounding and keeps moving forward. Right there is the appeal. I know no matter what happens, this keeps on going up while I can deploy the money in other areas. A lot of times what we'll see is someone has a lot of money in the bank. Their current strategy is to build that bank balance up, deploy it, real estate, business, whatever's earning them a high return, and then take the returns and refill their bank account. So if it's $1 million, they get it to $1 million, drop it to 5, refill it to $1 million, repeat that cycle. With this, why they like it is because their money keeps on compounding, whereas with a bank, when you pull it out, it does not. So I hope that made sense, but that's how a lot of people will use these policies. One last thing we can hit on is addressing a question that comes up. What am I getting from the insurance company? And that's in total dividends and interest. And what am I paying to the insurance company in loan interest? Mainly what I want to make sure of here is that I am not in a position where I'm paying more than what I'm getting from the insurance company. Or if that is the case, how do I get out of it quickly? So what we look at are two things in a case like this. Number one is year by year. So looking at this, in blue, you've got the yearly cash value growth, and in red, you've got the yearly interest paid. First 2 years with the policy, you're in the red. The reason why, if we look at year one, you pay in $250, your cash value is $222, which comes out to a hit of almost $28,000. Same thing in year two. You were at $220, you added $250 to it. If you just add $222 plus $250, you would come up with $472,000. Yet the cash value is $461. So you did not get all of your $250,000 back that year. That's why this column, the yearly cash value growth, is negative 10,536. Finally, in year 3, you add 250, you get your 250 back, plus another $7,800 in change. So what we're looking at here is the net growth, the actual money we're getting from the insurance company each year. Make sense? And then we'll compare that with how much we're paying in loan interest each year. So this example works really well because by the time we take a loan, the policy's been in force for a long time. It's really picking up the pace from a compounding standpoint, and the gains are well in excess of what we're loaning. It's almost double in this particular example. Where you can make this look not as attractive is if we increase the loan amount. If we took $800,000 instead of $500K or something like that. But again, this just isolates the yearly cash value growth with the yearly interest paid. And then we look at the total gain compared to the total interest paid. I love looking at the total interest paid. And the reason why is because have you ever had a mortgage and the rate is 3%, 5%? Whenever you took the mortgage out, the rate's different. But you've heard that what you pay is actually more than the interest. You ever hear that when it comes to a mortgage? A lot of people hear it, and the response is typically, okay, what am I actually paying? Because I heard something like it's front-loaded with mortgages, meaning I'm paying all the interest up front. And you can get into a very deep and technical conversation, or it can be difficult to grasp depending on how much I like numbers and such. But what really helps is if I could just look at how much I'm paying the bank in interest each year, and then just look at it year by year and add it all together. That's what we're doing here. So here we've got the total interest paid, which just tallies up the yearly interest you're paying every year, and there you go. So in this example, you paid a total of $96,000 in interest. That could change if the interest rate changes a little bit. But what did you gain? $563,000 at that point in time. Where we came up with that is at that point in time, how much did you pay into the policy? $1 million. Your cash value was $563,000. What's the difference between those two numbers? $563,000 and change. That's the gain. So that's where we compare the total gain with the total interest paid. And you can do it with any asset or anywhere you're putting money and you're leveraging it. We're just doing it with a life insurance policy because that's our thing. With all of that said, I hope that this made sense. I hope that you did enjoy it with respect to using the policy as a personal line of credit that demonstrates how people use it. In a later video, we are going to look at what we just looked at there, but with the actual illustrations from the insurance carrier, as those can be very confusing. So we'll just go through what the different columns mean and answer a lot of questions that pop up frequently. So I do hope this helps. Let us know if you have any questions, and we'll talk to you soon. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.